Hi, Greg Weldon here with Weldon Live for Friday, July 22nd, 22. And today it's about the horror. If you remember that from The Heart of Darkness is where that line comes from. Horror has a face, and you must make a friend of horror. Horror and moral terror are your friends. If they are not your friends, then they are your enemies to be feared. They are truly enemies. And The Heart of Darkness, of course, became Apocalypse Now, the great Francis Ford Coppola Vietnam story that really transcended the war in Vietnam. In fact, becomes about the millennial long war pitting good versus evil, light versus dark. And right now, when you talk about staring into the heart of darkness, it's the U.S. housing market that's staring into the heart of darkness. It's a full-blown crash in the refinance loan activity. It's a complete collapse in the home purchase loan originations. And as I suggested would happen, it is now fed through into slowing sales, because you can't have inflated prices and hugely inflated borrowing costs without crushing affordability and then choking demand, which is exactly what's happened when you get the existing home sales and a massive back-to-back monthly plunge. The next step would be, of course, the slowdown in terms of builder confidence, and we get, for the second straight month, a cumulatively huge decline in new housing starts. Wow. I mean, the real horror comes later, the next step, all right, when you already have this supply shortage, and if building, starts to slow because the economy starts to slow and demand starts to slow, that only makes the supply side dynamic even more intense the next time we come out of this, making inflation even higher when we come out of this. And if the consumer's still faced with higher food and energy prices, housing could get even worse in terms of, first the insanity of where prices are. And then secondly, I don't know. Frankly, you could make a case that we're seeing the beginning of the end. I don't want to get too alarmist or too doomsday-ish, but you're talking about, could you squeeze another cycle or two out of this? You absolutely could, because now you got 6% mortgage rates. You can bring rates down. But to get the entire ATM cash-producing machine that supports credit growth and consumption growth, enough so to support the debt, okay, which let's keep in mind, we don't need just growth. We need really good growth because the debt's higher than ever. So, just to have growth's not even enough. We can't stay still. That would be a death sentence. So the question becomes then, are we seeing the beginning of the end of a housing market where it really decays so badly that it feeds into the rest of kind of the asset price deflation you might have going on in equities to kind of create the situation where it becomes almost a little bit of anarchy in housing? You've seen it along the periphery. You've seen flashes of it in Occupy Wall Street. You see it in San Francisco. You see it in places where there are whole shanty towns. That's a vision of the future. And I think we're seeing the beginning of the end in the bigger picture rollover in housing, although it is at least a couple steps away, and if not maybe a couple of cycles away. So bottom line is, this is about the horror. And the horror right now is the economic data come out of the U.S. And it's only a picture that a true movie buff could love. Marlon Brando, okay, as, what was his name? I forget now. We were just talking about this. But Admiral Kurtz, who in one of the most famous lines in the movie, this movie has the most famous lines ever. First of all, you have Robert Duvall. If I say this beach is safe to surf, soldier, this beach is safe to surf. That's classic, okay? And then the other one is Charlie Don't Surf, okay? In that one scene where there's bombs going off and he's ordering Lance, the surfer dude from California, to get in there and start surfing. And he's surfing amid mortar explosions, right? It's great. And then the other movie, of course, is the last when they're going up the Mekong Valley, and they're going into the river, and they're going into wherever it was, Cambodia or Laos, when all now support from the U.S. military is gone, and Martin Sheen is playing the character who's reading the last letters that Kurtz had sent back to his wife in the U.S., and the last one was, sell the house, sell the cars, sell the kids, I'm never coming home. And that just is about as kind of frank, blatant, and gosh, man, it's fatal. That's a fatal line. And the wonder here is, how fatal is this damage being done in the housing market right now? Look at the plunge in housing starts. This is like the last thing to go, and it's gone. In 2 months, you've had a complete collapse. Now, you're back to levels you saw last fall, but this is primary summer building period, too. So now you have a lot of starts and you have a lot of homes under construction. I mean, you only have so much capacity. I get that, all right? But the bottom line is you were expecting it to increase. Now, it increased in the sense that they put a huge revision on last month's number, which made the decline even worse. I mean, that's what makes it amazing. So it looks like a 2-month decline. It isn't. It's like a 1-month decline because you're coming from 159 down to 155, down from 181. 181 to 159 to 155. That's a straight decline rather than 181, 145, and that would have been up had they not revised last month's number higher. This month would have actually increased, though less than expected. So either way, it's a bad number. We can slice this number 3 different ways. Every single way it comes out bad. All right? You're talking about a monthly contraction of 300,000 homes, permits, or rather new starts on a seasonally adjusted annual rate, and that's a lot. Not only that, but housing starts, you're looking at a potential breakdown in the trend that goes all the way back to 2010. This comes out of the financial market crisis, which was a housing market-led crisis, and the bottom in 2010, I mean, you got all these trend lines. You got this really tight channel. You broke down through the pandemic and came right back. This breakdown, there's no pandemic going on. I mean, although, depending on who you talk to, politically speaking. But again, the secular rise is at risk here. And here's where the secular problem lies. Because even though you were bloated at the 2007 high, and that was too many homes, all right, that you were building at a time, you have fallen behind because the huge decline, you never caught up. I mean, it took you until 2020, it took you until 2019 to get back to levels that you were at in 2003. I mean, think about that. That differential is a lot bigger. And when you consider the growth in population, you understand that because you didn't keep going higher, where'd you be up here now and have ample supply of homes, you never fully recovered. And now if you're going to decline again, that's problematic when you come out of it because you need the homes, and you're not building them. I mean, right now you are, but this is suggesting that trend is coming to an end. Now, permits, I mean, here's what I'm talking about. I mean, look at the permits. Permits fell 8%. That's a big decline from a million annualized to 967,000. I mean, when you look at it, it's almost 100,000 permits, in a month, let alone it's even more than that versus a year ago, down 11%. So that's negative. All right. Subtle but significant is the decline in homes under construction but not yet finished. All right. 824,000 down from 827,000, down from 828,000. When's the last time we saw back-to-back monthly declines in homes under construction not yet finished? A while. All right. So it's not a big decline, a percent, less than a percent, 0.5%. But it's a 2-month decline. And if permit's going to be lower and start's going to be lower, all of a sudden the pipeline dries up and there's no homes being built. And that's a problem. The mortgage rate, we know. I mean, we don't have to tell you this. Everyone knows this. This is a stat everyone can cite. 6% mortgage rate, 12-year high, ending a decade of ever lower mortgage rates from here. Because you're back to levels that you last saw in 2006 and 2007 when it was considered low. I mean, let's not forget, I keep saying this, I keep telling this people, where are we here now? That, I remember when 5% was considered ridiculously low when we first got down here in the early 2000s. I mean, don't forget, you went from 8-9%, and if you had a subprime, you're talking double digits, down to 5%, and it was like a miracle. And so the question is, how much can you recycle down here? And a lot of loans obviously were already done, below at near 2%. And in terms of refis, you're going to have to get below 2% and then by a margin of something below 2% to, squeeze out all of the, ATM power that you just locked up. Or I should say locked down. A lot of that money was taken. A lot of people have lower mortgage payments. There was a lot of benefit from all of that. That's not my point now, because now that benefit doesn't hit anyone anymore. Demand for refi loans has crashed. It's at the lower low, right, just in the latest week. And you see it's down 90%. The number of people doing refinancing loans on their homes right now is down 90% from its peak during the pandemic. That is a crash. That is demand that is wiped out. That's not going to come back quickly. It'll come back, just not quickly. You've tapped this, man. This vein's been tapped. Find another vein. It's kind of where we might have to go with getting back to monetary steroids, because there's a lot of similarities here. The home loan for purchase index, I mean, 3 straight months down, and it's down something like 11%, is it, or even even closer to 20%. 20% decline here in just 3 months, and a breakdown that continues now, that is solidified because you broke, you came back up, tested the broken trend line, and now making new lows. I love that pattern in anything. We're going to see that later in some of the stocks, stock market. It's a triple play in terms of existing home sales. This was a terrible number, all right? Total sales down, one strike, you're one out. Single family sales down, 2 outs. Condo sales down, 3 outs. That's it, inning over. In terms of supply, all right, in terms of months worth of sales, I mean, you have a huge increase taking place here. I mean, you were down at 1.6. All right, now you're 3%. It's almost doubled from January this year alone. It's up 15.4% for the month, up 20% year over year. And single family homes, not quite as much short term, but still the same. I mean, 1.5 to 2.9. It's almost doubled. All right, so we'll see how that plays out over time, whether that continues, and nominally whether that starts to mean you really do have a building supply, which I know you do because I see it. Because I look at the listings here in South Florida literally every day. And here's existing sales. I mean, look, it's 1, 2, 3, 4, 5. 5 months down 21% nominally, 50% annualized rate since the beginning of the year. Let me say that again. Existing home sales are down at a 50% annualized rate in the first 6 months of the year. I mean, that's bad, man. All right, and even lower than expected. They were expected to fall. They fell more than expected to fall. I mean, expected it was 5.41 million. Expected to go at 5.38. It's 5.12. That's a massive miss, man. It's a huge miss. That's a 5% miss to the downside. And frankly, this is halfway to a crash. I mean, you were crashing here. You're crashing here. I mean, again, it's kind of one of those things that's like, where is the notification here going out to people that the housing market is crashing? Existing sales prices are up, but guess what? They're always up in June. It's a seasonal high every single freaking year. I mean, it really is. I mean, it's one of the most reliable seasonal patterns in anything that we track here, right? And 13.4 year-over-year rate far exceeds CPI. So, home price is going up, but that's part of the problem. I mean, and here's your seasonal peak, so maybe they'll come down, supply coming down, prices coming down, maybe rates, maybe the fact that demand is so much lower and rates are so much lower. I can tell you rental prices here in South Florida have come down, and noticeably so. And there are homes that have not rented, and that was unheard of in the fourth quarter of last year, first quarter of this year. It was beyond tight. You would have to wait sometimes 2 or 3 weeks to get a single rental listing for a single-family home back in November and December. The Philly Fed survey was really interesting. First of all the front-end indicators down. I mean, because these are the demand, and it's the production, it's these, the new orders, the backlog of orders. What's the order flow look like? All right. But if you look at the delivery times, we've been waiting for this. How long have we been waiting to see some give in the supply chain? And here it is in spades. All right. When you're talking about delivery times decreasing, now greater than those saying delivery times are lengthening. That is massively important. And not only that, it's 4-1 now on the expectations. So the fear of future supply chain issues in the second half of this year are all but dissipated. That is massive in terms of confidence. That is massive in terms of a stat that kind of frees up the thought process. Inflation is going to stay high from here. I mean, I started talking about inflation peaking last month. I mean, so we're already on the other side of that train. We're already long the short end of U.S. fixed income. We've already made the shift. The market hasn't made it yet. The narrative hasn't quite gotten there yet, but it will, and it's going to kind of follow our lead because we're following the lead of the data.